Netflix is set to report fourth quarter earnings on Tuesday, right here, after a blockbuster quarter that featured the second season of Squid Game and the NFL's Netflix debut on Christmas. And joining me now is senior analyst at Seaport Research Partners, David Joyce. Upgraded the stock this week to a buy. David, welcome. You did that in part because you expect the member ads to be much stronger?
Yeah, so thanks for having me, John. I wanted to recognize that the stock had pulled back earlier in January, in large part on FX fears. But I really think that the fundamentals really have a lot going for them. As you mentioned, Squid Games had more than 68 million views in the first episode of the new season. NFL games like Christmas had more than 24 million concurrent streams. The Paul Tyson fight had 65 million streams. The WWE Monday Night Raw did more than twice the ratings that they did last year on the USA Network. So they've got a lot of good content going for them. They've got a lot of great engagement going for them. With the fans and the viewership, and with the pullback, I think that this gave us another opportunity to get more constructive again.
Well, at the same time, I think at your price target, Netflix would be worth 2 times Disney. Is that justified?
Well, there is a lot still going for it. They've just really embarked on the advertising part of their business model. I think they'll do about $1.7 billion in advertising in 2024, but they can more than double that to over $4 billion next year. So there's a good growth trajectory there. They're still attracting a lot of great new content projects, film and episodic content. They had the most nominations throughout Hollywood for the recent Golden Globes. So they have a lot of talent that wants to work with them, and that's going to continue to bring in viewers and retain viewers, which makes it highly economic for them. Plus, their margins are on the studio are better than the other peers. So I think when you've got these positive trajectories, I think that's all still warrants a better multiple than some of the other peers.
That sounds good, but if I were going to argue the other side, as I am prone to do, I would say just months ago, people were saying ads were a big justification here, but those don't seem to be panning out as quickly as hoped. And then international growth was supposed to be the story, but the dollar is strong. At what point might those things start to matter now if they don't, show up differently than they appear to right now?
Well, I did note that some of these FX fears, because of the dollar, did pressure the shares earlier in January. And the idea there would be if management's guidance of 11 to 13% revenue growth this year might be brought down a little bit when they report on Tuesday. I think it'll still be too early in the year for them to reduce guidance. But I think that the FX impacts are really temporary. I think that the fundamental aspect is that they've got a global platform that nobody else matches at this point in terms of being able to have a single ad buy to reach people really concurrently around the globe. And that's an area where the other peers like Disney are still lagging. They're still working on it. They're working on cracking down on password sharing, and they're working on layering in the ad tiers. But I think that's where Netflix has a bit of the advantage right now.